Hello, everyone, and welcome to Economics and You. I am your host, Mr. Samuelson. Today, we're going to be looking at investing your money. Several options that you can take that are a little bit more risky than your savings options discussed in our last lesson. But these investment options, if done right and done well, can yield pretty high results for you. Let's talk about our most risky one first, stocks. See, companies issue stock. And this is a specific ownership share of that company. So when you buy a stock, you're buying ownership of the company. That is, you are actually an owner of that company. And companies will do this. They'll sell off these ownership shares in order to quickly raise money and to expand. Now, if the value of the company increases because of this expansion and it's done well, then the value of that share of stock increases. And you can make a lot of money and make it fairly quickly. If, however, that expansion does not go well, and the company doesn't manage it well, the company could actually lose value, and so would your share of its value. So we're now into a higher risk area with greater potential for rewards, but also for loss. Investing in stocks does not guarantee a profit. Okay, a savings account in a bank, yes, your interest rate is going to go up. Your mutual funds, your CDs, those are all going to work out positively in your advantage, but not amazing strategies for gaining tremendous amount of wealth. Okay, those are safe investments. This is risky, but the rewards of it can be very high. If you get in on the ground level of a company that really takes off, you can substantially increase the value of your shares. Now, investing in bonds. Bonds are a loan of money, and you're loaning money either to a company or a government. Okay? So a company or a government needs to increase the amount of money that they have in order to expand. It's largely what they're trying to do here. This is an expansion. And they seek out loans from the public. They seek out loans from you. Can you loan me some money, please? Now, bonds do pay interest on those loans to the bondholder. Okay, so you do earn interest on this loan to the company. And this interest rate is usually going to be better than a, say, money market account. Now, bonds are less risky than stocks. Okay, the company is most likely going to be able to pay back the value of that bond. If, however, a company fails, if you were to get a bond from General Electric, and General Electric, GE, were for some reason to fail, it's not going to, it's a huge company, but if it did, you would lose the value of that bond. So it's not as risky as a stock, but it does carry risk with it. Treasuries are usually considered the least risky of these investments. These are loans to the United States government. With a treasury, you are specifically giving money to the U.S. government, and the U.S. government is promising to pay you back with interest. T-bills are the lowest interest rate. Okay, T-bills are loan. You buy them from the government, and they have a very low interest rate, usually at or even below inflation. And they mature 1 to 6 months later. People will buy T-bills if they're afraid that the economy is about to go into recession, and they just don't know where is safe to keep their money, and they want to make sure that they're going to beat inflation. Although T-bill doesn't always guarantee that you'll even beat inflation, but it is safe. The U.S. government guarantees that they will pay you back that money. T-notes, Treasury notes, have a better interest rate, but they take 2 to 10 years to mature. So think about this like the CDs that we discussed before. The T-note, you can't cash it out early, but it will give you a better interest rate. You can see the one that I have a picture of right here is an 8% Treasury note. So 8% on a loan to the government for a 10-year period of time. That's a good, solid return. Okay, it's safe. You're sure to get that 8% back. Now, T-bonds, Treasury bonds, are going to give you the best interest rate, and these can go as high as 10, 12%. But it takes 30 years to get that money back. It's safe, it's guaranteed, you're going to get your money back, you're going to get it with interest, you're going to make money, but you don't get it for 30 years. Now, generally, T-bills, T-notes, and T-bonds, you don't want to invest in these as your only means of investment. This is where you put your money to keep your money safe when you know that you're not going to need it for an emergency. Keep cash on hand, keep cash in other investments that's easier to access. Treasuries are not the easiest way to get access to your money. All right, stock and bond markets. So organizations have actually formed around the idea that we are experts in stocks, we are experts in bonds, we can help you with this. You don't know what you're doing, we can help you. And these organizations have been formed to do that. Now, brokers, stock brokers and bond brokers, are the people who manage the purchase and sale of stocks and bonds. So if you wanted to purchase a whole bunch of stock, you would go to a broker. The broker would time the purchase of that stock to best benefit you and make sure that you could maximize your profits. And brokers will, claim expertise in this. A lot of people invest in stocks and bonds without the assistance of brokers, and many of them do just as well, because a broker is going to take a fee. They're going to take a percentage of any money that you earn on any trade, or charge you a flat rate for every trade that they're involved in. Some people don't want to pay that fee. They don't want to pay that rate to the broker, and they'll do it themselves. This is very, very, very risky, but some people do it very well. Brokers are a little bit more experts on this, but understand you're still taking a pretty big risk with stocks. You're still taking a risk with bonds. These are not guaranteed profits. Now, an exchange, you've probably heard of the New York Stock Exchange. And if you haven't, the New York Stock Exchange is the biggest stock exchange in the world. It's where people go together to buy and sell shares of companies that they own. And specifically, it will be brokers on the floor of the New York Stock Exchange managing this. They are buying, selling, and trading stocks and bonds with other brokers representing other people. Mutual funds. Now, mutual funds are what I really want to focus on for your investment strategy. This is a good way to take a risk that is a reasonable, manageable risk, and you don't need to be particularly well informed to do so. Mutual funds invest money in a wide variety of stocks and bonds. You get in with a company that manages mutual funds, and they are going to pick your stocks and your bonds for you. You're not really going to have that much of a say. Now, this spreads the risks amongst many other smaller investments. So instead of putting $100,000 into one company, and that one company may go boom or may bust, you could really walk away with a fortune or walk away with nothing. They're going to take that $100,000, put some into bonds, a little safer, and some into stocks. And that way, if the stocks all go down, the bonds have at least protected some of your money. And that's the idea of a mutual fund, spreading the risk amongst many different investments. Now, an indexed fund is really the best, safest way to go. Index funds invest in an entire stock index. Okay, they invest just a little bit in a whole mess of companies. And if the index, that is like the Dow Jones stock index, which is a collection of investments, if that were all to go up on average, then your investments increase on average. It all goes down on average, your investments decrease. But these big indexes, over a long enough period of time, always go up. Like, for the history of these indexes, you put it over a long enough timetable and they always go up. If you invest in an index fund over a 10-year period of time, that will increase. Your timing of how you sell your stocks is important, but this is a safe, guaranteed increase on funds that will probably beat your money market accounts and could possibly beat your CDs as well, with the advantage of being able to withdraw money when you need it. This is a great way to invest if you are a young, inexperienced investor. That is, you guys, when you're in your 20s and 30s, mutual funds are the way to go. Index funds in particular, that's where you want to be investing because it will promise a pretty high return with pretty low risk. Government regulation. How do we know that this is all going to happen and happen fairly? Well, the government has created a division called the Security and Exchange Commission. This is the SEC. And the SEC regulates stock and bond markets. That is, they make sure that laws are not being broken. That is, companies aren't lying about the value of their company in order to sell more shares of stock, or that companies aren't trading stock with each other in a way that cuts others out of the market. So it mostly just ensures that all information shared with the public is shared equally, fairly, and honestly. That is the job of the SEC. And corporations must make sure that they are treating their investors fairly. They cannot lie to investors about the value of that company. All right, so that was investing. I certainly hope that you learned something today. Farewell.